Alright, welcome to another video. This is the walkthrough for the weekly S&P 500 ChartStorm. This is really just me using my voice to add a little bit of extra context and comments around the weekly ChartStorm that I do on Twitter. I will note also that I am renewing the practice of putting it into a write-up on Seeking Alpha as well, so check it out over there. And anyway, into it. So, here we go, it's that time again. First chart here is from Tiho Birkin, and he is a pretty good chart master to follow as well. Definitely want to be checking out what he's doing, and what he's created here is a chart of the drawdown percentage for the S&P 500, and you can see there that there has been a very smooth run. Been a long time since we've had a very serious drawdown. I mean, that one in early 2016 hardly even got to, I don't think it even got to 15%. It was about a 10% correction top to bottom, but it's been a pretty smooth run, so it can probably contributes to some of the optimism that we'll be talking through later in the piece. Number two is a composite view of seasonality. So most people have probably seen the seasonality charts before, like this one, which I'll go through in a second. But this one combines three different cycles. So if you think about seasonality as one cycle, and that's the cycle for the year, the cycle for the seasons, and there's a fairly well established, well understood pattern there. And then there's the 4-year presidential cycle, which you have, you tend to have the best performance just in the lead up to the election, as the parties try to ply the public with a bit of policies and extra performance to try and goose the market up, boost confidence, and usually the worst performance is in the year after the election. So the other one is the 10-year cycle, and that's sort of just this tendency for there to be a cycle across the 10-year period. And that one, it's the years ending in 7 that tend to be the worst. So anyway, when you mix that all up together, this is what you get in the purplish line there, and that's really implying that there should not be a good time in September and October. So it's just mapping what's happened in the past, and that's as all those disclaimers always tell you, the past does not equal the future, or past performance is not necessarily a good guide to the future, but it's one of the best things that we've got, so something to keep in mind. And then turning to the seasonality chart, we've still got the most negative patch of the year to go through in terms of negative seasonality. And at the moment, the market's kind of defying the seasonal gravity, if you like. After that, if we do get a decent correction into September, October, I'd say there's a risk of one, probably medium risk. Then the positive seasonality kicks back in. Moving on to number 4, this is one of my own again, and this is the US Economic Noise Index. This combines the signal from the Economic Surprise Index and the Economic Policy Uncertainty Index. Really what it's designed to do is capture the background economic noise in the economy. So if you think about Surprise Index, that's whether the data is coming in better than expected, and the Economic Policy Uncertainty Index is whether there's more or less uncertainty about economic policy, and that one is news driven. So because it's news and data driven on both fronts, it's basically capturing the noise that's going on. And this is the type of noise that really materially impacts on sentiment, drives sentiment, and also reflects what's actually going on in the economy. So you'd expect well, that's probably the sort of the actual logic behind why it would be a market signal. And here we've actually compared it to what's going on in the S&P 500. And you can see there's a couple of signals to note. So first one is when it gets to extreme negative noise levels. So, very high levels of negative noise or bad noise. That's often a market bottom, at least a short-term bottom. We saw a short-term bottom in '08 before the big bottom signal came in '09. And the other signal on the other side of the market is when the noise gets really good and then rolls over. And we've actually seen that happen in recent months here. So, in that respect, it's pretty much a contrarian signal and one to keep in mind. Speaking of contrarians, if you like good contrarian kind of signals, here's potentially a good big one for you, and it's the TD Ameritrade Investor Movement Index. This is a gauge of sentiment based on the activity of their clients. So it goes up when their clients are increasing net purchases of equities, and you can see that there's been very increasingly heavy retail participation in this latest stage of the bull market. And that's reflecting really quite optimistic, euphoric, exuberant attitudes, really. It's it's in contrast to some of the surveys. This is what people are actually doing. So it's quite a useful and interesting index. And in terms of the signal, when it gets to an extreme, I mean, that's something to pay attention to. When it got to extremes there and there, to pick the market tops there, I think those were 2011 and 2010, those market tops. Rolled over quite some time before the 2015-2016 corrections. So yeah, at the moment it's at extreme levels, which is informative in and of itself. When it rolls over is probably another piece of information on the bearish signal front. And staying with the topic of optimism, this one here from Lance Roberts. This one, it is the stocks versus cash ratio from the AAII portfolio allocation survey. And it's going to go up when stock allocations go up or cash allocations go down. And that can happen of two ways. Either the market takes the investors there, the market goes up and just increases the value of the existing equity allocations. If you don't rebalance under that scenario, then of course your equity weight goes up automatically. And the other is more of an active approach where people are just deploying cash. They have FOMO, their fear of missing out, and they want to get on and want to get some participation in this market that apparently only goes up. So yeah, and in terms of the signal there, well, yeah, again, it's another sentiment type of indicator, and when it gets to extremes, that's something to pay attention to. I would note that it doesn't capture the bond element there, and there's been some switching in and out of bonds versus cash. I think we did see quite a big shift out of cash into bonds when zero interest rate policy was implemented. So that's why you can see that it's at a generally higher level post '08. Might be worth taking a look at that. Maybe I'll have a look later on. Coffee sip break. Alright, and number 7 is a interesting chart from Alexander Forbes Investments, shared by Rob Price 58. Now this one shows very similar chart, and it is the S&P 500 market cap versus money market mutual fund asset under management. and that one has gone to extreme levels. Now again, the post '08 period probably is a little bit overstated, just by virtue of the fact that it makes very little sense to hold cash from a return point of view or an income point of view when cash rates are close to zero. I mean, cash, of course, has tremendous value as a preservation of capital function, because, bonds may not always perform that function. If there's a bond market crash, your capital is not preserved. If there's a stock market crash or a bond market crash or both, cash just sits there. Its value is unchanged, basically. I mean, if anything, the value of cash goes up in a market crash because you can buy into those assets at a cheaper price. So, yeah, I mean, but even if it is overstated, it is definitely at high levels, extreme points. So, very interesting chart. And, taken along with the number 6 and number 5 charts, really does start to tell a story of the market where there is very much the skepticism is being put aside, or the skepticism's being held only in the mind but not in the actions. Number 8, sort of kind of an unusual chart, really. It's the percentage of S&P 500, S&P 1500. So it's a pretty broad universe of stocks. The percentage of those outperforming the S&P 500 that's rolled over, and the average stocks are lagging at the moment. Probably a reason to notice that is that it started doing that in the lead up to 2007 top. But as you can see there, it doesn't really, throughout that period, it's not necessarily lining up with tops and bottoms in the market. Still an interesting piece of context, bit of breadth analysis, I guess, and another way of saying that market breadth is a bit patchy at the moment. So I guess probably has a slight bearish slant to it, that signal. Number 9. This one is very interesting, and I'm not sure what's behind this one. I'm going to have to go and do a bit of research into this one, because we've seen this big drop in share buybacks. And I mean, a lot of people probably look at this chart and look at the 07-08 period and think, well, that's like a premonition there. So a couple of things to note. First of all, when buybacks rolled over in 2007, 2008, they were rolling over with the market. They were rolling over because the credit markets were falling apart. I mean, the cracks were appearing at that point. At this point, there's no cracks in the credit markets. I mean, the credit risk premium is incredibly low. There's been some tightening in the Fed Loan Officer survey, but the economics are still very supportive of where credit spreads are at the moment, by my indicators. So it's not that. That sort of leaves two other possibilities. One is that people are in, the corporates are in wait and see mode, because a big driver of why you've had such steady and consistent and substantial corporate buybacks is because a lot of those firms who have offshore earnings, they don't want to bring their cash back and get taxed on it. They're sitting in these sort of tax loopholes. So you have this sort of I don't know what you call it, imprisoned cash or refugee cash that's sitting over offshore, and one way to get that cash back and give it to investors is to keep the cash there, maybe invest it in something, and instead issue bonds and use the funds from that bond raising to do the buybacks. So it's a bit of a financial engineering, tax avoidance, tax. Maybe we don't call it tax avoidance, but we call it tax efficiency, tax optimization, or balance sheet optimization. And you know, if that is what's driving it, I mean, you can't blame them. You know, it's more a reflection of a broken tax system that, you know, or broken regulatory system that people are behaving in this manner. You know, if you set up a certain system for people, they're just going to operate um, under the, you know, the guidance of the incentives and constraints. You know, that's pretty much the fundamentals of economics. You know, and so if that is a result of wait and see mode, maybe buybacks will come back with a force later on if you know, if tax reform isn't delivered, or you know, otherwise maybe they'll resurge once tax reform is actually delivered and you get big repatriation of capital. And of course, the other reason why you might see a drop in buybacks is if companies are reallocating that cash instead of buying back stocks, paying dividends. Maybe they're putting more into M&A and CapEx. Haven't really seen that in the numbers, but I'll have to go and check on the M&A stats. Did see a little bit of a tick up actually in global M&A, so maybe there is something to that. Anyway, it's definitely a very interesting chart, probably the chart of the week, I would say. If I were to pick one out, maybe that's something I should do from now on. Anyway, this is the chart of the week, so I'm going to click like. There we go. Now, last one is really just a little bit of context and perspective. Shows the current market versus some previous bull markets. You know, it's gone further and higher than some, but not others. I mean, there's a little bit of a technicality in this one that, you know, if you're measuring periods where, you know, there is, you know, unremitted expansion, there was a down year in 2011, but I guess, you know, from the bottom to the top is probably, well, the bottom to where it is at the moment is probably what they're getting at with this. Anyway, interesting context. And that is it. If you have any comments, questions, complaints, or indeed if you have any requests or submissions for future episodes, please do send them through. The other thing to point out again is the write-up for this over on Seeking Alpha. I'll put the link to that into the description of this video on YouTube. I'll also put a link to the moment here. So this is the Twitter moments. I'll put the ChartStorm into this. It's kind of a good way of putting it into one place. And yeah, and if you like the video, please like the video on YouTube and subscribe to the channel. I'll be putting out a piece later in the week as well, something macro and markets, something on the asset allocation front.